Welcome. Chapter 6, Bonds and Bond Valuation. This is part 2 of Chapter 6. Learning outcomes. So far we've understood what the basic bond terminology is. We've seen what's coupon, coupon rate, face value, yield to maturity, and price. We've applied the time value of money equation after laying out the cash flows that are applicable to a bond in pricing of a bond. After going through this presentation, students would be able to analyze the difference between annual and semi-annual bonds, analyze the connection between coupon rate and yield to maturity with respect to price, and then connect the price changes with durations of bonds. So whether prices change more for long-term bonds or less for long-term bonds as compared to short-term bonds. And later on in part 3, we'll analyze the pricing of zero coupon bonds, deduce the effect of bond ratings and bond prices, look at rate of return on bonds, and pricing of bonds in terms of 30 seconds, and look at the price of government bonds and notes. So let's move on to semi-annual bonds now. In the previous presentation, we'd seen how annual coupons are paid out and how the bond is priced based on that. Now in this part, we will go to reality. In reality, all corporations and governments pay coupons semi-annually, and they treat these. We need to treat these as semi-annual cash flows, and make sure that the yield to maturity and coupon rate are adjusted accordingly. So now we will have to tweak our time value of money equation. In other words, like we just said, the payments will be divided by half. The annual payments will be divided by half, even though the coupon rate is annual. Number of periods may be the number of years, but now if it's semi-annual, then we have to split it up into two pieces. So it's twice the number of periods as compared to the number of years. And the yield to maturity also will be treated as exactly half the annualized yield to maturity. So yield to maturity essentially becomes an APR when it's reported in the real world, but we have to get down to the periodic rate, which is half of the discount rate or the yield to maturity. So let's continue with our example. To find out the PV, present value of a 20-year bond issued in 2015, but today is 2025 and will be maturing in 2035. So the time to maturity is 10 years, and the coupon is 3%. The face value is $1,000. The coupon is now this bond is a semi-annual coupon bond, and the yield to maturity is still 2%. What is the price today is what our conundrum is. Now let's look at the cash flows first. So to look at the cash flows separated out, today is t equals 0. It doesn't matter when the bond was issued. As far as that is concerned, it is gone, history, past. So in 1 year, in one period or 6 months or half a year, the coupon that a lender will receive would be the annual coupon, 3% of 1,000 or $30 divided by 2, which is $15. In 12 months or 1 year at time t equals 2, there will be another coupon of $15. And this will continue until we reach 19th period from now, which is 9.5 years, of $15, and the 20th coupon will accompany a face value. Redemption of the bond is done in 20 periods from now, or 10 years. So now we use the same equation, except now our coupons are semi-annual. The rate, or YTM, is going to be periodic rate, a 6-month rate, and the number of periods is going to be how many 6 months from now instead of how many years from now. So the same time value of money equation is used, except now we expand it further. So the present value would be a sum of these annuities that are annuity cash flows that are getting discounted by the exact periodic rate. Notice the YTM was 2%, so the semi-annual periodic rate is 1%. So in the denominator, you have 1% plus 1 plus rate, 1 plus 0.01 or 1.01. Then 1.02, 1.101 to the power 2, and 1.01 to the power of 20. The last cash flow, as usual, is the par value plus the final coupon. All right, now there are three methods to find out the present value of this bond or the price of this bond. let's use some of these methods. So first step is to lay out the cash flows once again. So now we have 1 equals this plus 1, and then instead of 10 we have 20 cash flows. So we have to adjust it accordingly. The cash flow will be equal to, so let's just set our conditions here. So first of all, YTM is 2%. So this is annualized, right? The coupon rate is 3%. The par value or the face value is 1,000. And the TTM is 20 periods, obviously. So equals the coupon rate $C$2 times $C$3 divided by 2, semi-annual. That's our cash flow. This will go all the way through the 20th period, and so function F2 plus $C$3, which is the par value, so it becomes 1015. So how do we find out the present value? So to do that, equals this divided by parenthesis 1 plus $C$1 divided by 2, close parenthesis, to the power of the number of periods. Shift Control 1, black cross, double click. The formula percolates, and then just add these up. Sum of all of these is the present value or the price of the bond. The other way to find out the present value or the price is equals PV of rate $C$1 divided by 2, number of periods 20 periods, comma, payment minus of 15. Let's assume this time we are the borrower. The face value, the future value is minus 1000, and then the type is 0, 1090.23. The third way is, which I have not discussed so far, is just to find out the present value of each cash flow using the PV function. So $C$1 $C$1 divided by 2, number of periods is 20. It's not 20, is this A5, comma, the payment. There is no payment now. Each cash flow is treated as a future value, so minus of 15, and the type is 0. So we use the PV function to get the exact same answer. Copy paste and then sum it up, Control R, sum of all these. So 3 different methods giving us the same answer, 1090.23. Now there are even more profound implications here. So what happens if the yield to maturity changes from 2% to 3%, 4%, etc.? So what we're going to do now here is just keep using the present value function. So I'm just going to copy this and make sure that everything else is fixed except the rate. And I'm going to change the cell which was referencing the rate now. So what we'll do is, instead of here, we'll now make it 2%, 3%, 4%, and 5. And then change it from C1 to B28. $B, not dollar anymore, B28. Or, yeah. Same answer, but now interest rate is changing. Notice what happened. Here, the price became 1000 equal to par. Wow, how did that happen? Well, what happened was the interest rate of the market is now equal to the coupon rate of the bond. See, the coupon rate is 3% and the market interest rate is 3%. So this is the YTM, the discount rate. And as the discount rate increases, the price is constantly decreasing. Correct? So this is the price. In fact, we'll call this the price of our 10-year bond. Notice how the number of payments, payment value is this, but the number of periods is 20, right? Now, what if we were to make this a 20-year bond or 30-year bond, even worse, long term? So what we're going to do is Control R, but instead of C28, make it B28 again. The rate is B28 by 2. The number of periods is 30. Just remove that, make it 30. And the cash flows are still same. The coupon rate is still 3%. And the par value is still 1,000. So the price has gone up for a 30-year bond. Now notice what happens. The price becomes par again. So this thing is repeating itself no matter what the life of the bond is. Very profound implication. If the coupon rate equals the yield to maturity, the price of any bond is equal to par. Very, very profound implication. As long as the coupon rate equals yield to maturity, the market discount rate, the price will be par. Let's remember that, okay? So now let's just paste special formula here and just Control D. Notice what's happening. So the price change in this case is approximately $90, approximately $80, approximately $845 through $915, so about $70. Now here, 90, 80, 70, right? Here it's $130. Then here it's $112. And then here it is, let's just calculate it, right? For the sake of simplicity, it's equal to this minus this. And just Control R. But this is a change for this side, for the 30-year bond. So on the left is the change in price for the 10-year bond. So change price 10 and change price 30. Notice how the 30-year bond always is winning over the 10-year bond. The changes in price of 30-year bond are much more volatile or fluctuating higher as compared to the 10-year bond. That's a very profound implication too. So what have we seen so far? First, as the YTM increases, the discount rate of a bond increases, its price decreases. Notice the shrinking arrow and the growing arrow, correct? That's the first thing we've noticed. The second thing we've noticed is when the YTM is equal to coupon, the price equals par. And so let's just recapitulate and summarize. At low YTM, below the coupon rate, the price is high. If YTM is less than the coupon rate, like here, 2% is less than 3%, the price is above $1,000 or par. That's the first thing. So price above par, and the bond is known to be trading at a premium. In this case, the premium is of $90.23. So the premium is called $90.23 premium. It's how much above the par value it is. Now as the YTM increases, the price decreases. Here, for example, the YTM is 5%. It's much bigger than 2%. And look at how the price has gone down. So the price now becomes less than the par. In other words, $844 is less than $1,000. In other words, the difference of $155.89 is a discount. So 155.89 discount. So when the YTM equals coupon rate, 3%, the price equals par, $1,000, which we see here. These are some profound implications. Then we saw a summary of changes to price when we have a 10-year bond and a 30-year bond. So notice how the 30-year bond always fluctuates more than the 10-year bond. So to conclude, YTM is called the fulcrum around the coupon rate. When the coupon is par, the price is when the coupon is equal to YTM, the price is par. When the YTM decreases, the price increases. When the YTM increases, the price decreases. So the price of the bond goes from discount to premium or vice versa, depending on how the interest rate changes. So volatility in price is much bigger for a long-term bond as compared to a short-term bond. To summarize, a bond is a debt instrument with cash flows that are fixed. A semi-annual bond has cash flows laid out more extensively than an annual coupon-paying bond. So these coupons are very important in determining the price of the bond, as is the face value or the par value, which is the value returned to the investor at maturity. Usually in bonds, coupons are paid out semi-annually, and the price is the present value calculated from the TVM equation. That's Chapter 6, Part 2. Thank you for listening.